Your paycheck arrives every 2 weeks. You glance at the bottom number and move on. Big mistake. You're probably leaving thousands of dollars on the table. Most people never look at their pay stub. They don't know that they're paying $800 more in taxes than necessary. They don't realize that $40,000 of RSU income means they owe $14,000 in taxes, even if they never sold a single share. Understanding pre tax deductions alone could save you thousands per year. And that's a vacation, a car payment, your kid's college fund. It's your money. You just need to know where to look. Take 5 minutes, read your pay stub, look at your pre tax deductions, cumulative totals, and RSU vesting. Your future self will thank you. Don't leave money on the table. So here's a sample earnings statement. So you got a company name here, you have the employee information, and this is pretty standard. Formats are going to be a little bit different, but for the most part, it's pretty standard. You're going to see the pay period. Some people get paid every 2 weeks, some people get paid every month. In this example, it's a 2 week period. And then here's the pay date when they actually get paid, where their pay hits their bank account. And then the payment method, direct deposit. Some people get paid via check, paper check. So here's the top of the earnings statement. Now going further here, we got earnings, right? So there's different type of earnings. There's your salary. So in this example here, it's regular pay, overtime pay. So that's your salary information. Then there's like additional add-ons. So a lot of our clients get RSUs, restricted stock units, and then there's bonuses. So the way to look at this is your gross pay. So this doesn't necessarily mean what actually hit your bank account. Think of this as you sign with a company, right? And your employment contract says you're going to get paid $400,000 for the year. So the $400,000 gross component is going to show up here. Then there's going to be deductions. So the key here to understand is your whatever your contract says, divide that by, in this case, 26 weeks or every two weeks. And this is what your gross should be. Then there's overtime pay. With regarding the RSUs, what happens with these is once they vest, you have to pay tax on them, and they're included in your W-2. Now, some companies will withhold tax, okay? Other companies won't. If they withhold tax, they may not withhold enough based on what tax bracket you fall into. So it's important to kind of understand as you get these RSUs and as they vest that you have enough tax being withheld. And that's why looking at these earnings statements, like at least every quarter, is important. And this will help you make any quarterly tax estimates. So that's RSUs. And then there's bonuses. And this is one area that we see a lot of clients kind of miss. And it's not necessarily their fault. It's just because, when you add in bonus pay, it could push you into a different tax bracket, right? So bonuses, your employer may withhold 22%, right? But you might be in the 37% tax bracket. So that there is what you're going to have to pay in tax when you do your tax return. So it's important to kind of look at these bonuses. And right now, we're doing a lot of tax planning with our clients. And one of the things that we're asking for is to look at their pay stubs, because the pay stubs will help us kind of project what their tax liability is and see if there's anything that they can do to kind of lessen the load of their taxes come April. So this is the gross section. Now we get into the deductions. So in this example, I kind of added health insurance and then the 401k retirement. So pre-tax deductions, what this means is we're taking your gross pay and we're reducing that. Okay. And that's kind of a good thing. So if you think of like a 401k, companies will allow you to contribute the max per year, right? Which is, $23,000, for example. Then they have a match on top of that. But what a lot of people do is they only contribute up to their employer's match. They're kind of leaving money on the table because you're funding your retirement, but it's also reducing your taxable income that you're be paying tax on, and that's why it's pre-tax. So it's good that you want to kind of max out this. If your employer offers this, you want to max out their retirement plan. And then health insurance, it's another thing that's pre-tax, right? So you're buying this health insurance and it's pre-tax, so it's going to reduce your gross pay here. So again, you got your 2-week pay period information here, and then you got the cumulative for the year. In this case, it's through the end of October. And there's other pre-tax deductions, but these are kind of the common ones here. And a way to kind of also look at this is, all right, so you contributed $12,000 to your 401k plan. There's 2 months left in the year. You're trying to figure out ways on how to reduce your tax liability. Here's one, right? You're only contributing $2,200 every paycheck. Why don't you change that before the end of the year and contribute more to reduce your taxable income? So then here's your taxable income, right? And this is what you're going to be paying tax on. Okay. So you're trying to, for business owners out there, we kind of look at your income statement. For W-2 employees out there, we're kind of looking at this and seeing how can we reduce to get to your taxable income. You started out here, now we're down to here. So what else can we do? So this is going to show up on page 1. And then here are all the taxes that your employer withheld from your W-2 and paid on your behalf. Okay. So during the tax planning time that we're doing right now with our clients is we're kind of taking a look at, okay, how much did they pay in taxes versus what their taxable income is? And based on that, we can determine whether they overpaid or they underpaid, or they kind of stayed break even here. So this is kind of important to kind of monitor. And you got the federal tax withholding here, and then you got the state component here. So again, and this is all driven from that form. It's called the W-4 form. The IRS has a great resource on their website that allows people to kind of estimate what their tax liability should be and how they should complete the W-4 form. The most conservative way is to kind of say 0 allowances, 0 exemptions, and that will note that you're kind of having the most tax withheld. That's the most conservative. But if you want to figure out the exact amount of withholding, you can use that tool. Also, when you get hired from these companies, you fill out all these HR forms. One of them being the W-4 form. You fill it out, and life changes, right? You get married, you have children, and those changes impact your W-4 form. Now, the beauty of the W-4 form is you can update that as many times during the year as you want, right? You can tell your employer, I want more tax withheld, I want less tax withheld. But anyways, that's the driver of this, because you're telling your employer how much tax you want withheld. In the early days, we had a client that it was like 24 exemptions, 24 allowances. So their paycheck was very high, but this number right here was very low. So their paycheck that they got from their employer that hit their bank account was very high, but they had barely anything being withheld. And you could do that, but then when you do your tax return, you got to pay the IRS back in taxes. So now we arrive at your net pay here. And the net pay is essentially what's hitting your bank account. So, you started out at $47,000, and then your net pay in this example is $31,000. And that's one thing that we hear a lot of people, I won't say complain about, but they question like, wait, my gross pay was this, where's everything going? And this summary here will tell you exactly where all your money's going. And then this hits your bank account. Here's the current pay period, and then here's the year-to-date pay period. And then in this earnings statement here, I actually your statement's not going to show this, but understanding your deductions, pre-tax health insurance, I kind of walked through a lot of this already. But it'd be nice that employers would add this, as it's a good explanation. So that's the summary of the earnings statement. Again, a very important statement. You should look at it every quarter. Any questions, let me know. Thanks.